Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. In this chapter, we're going to learn about the various approaches that companies use to account for investments when a company makes a debt and equity investment of another company. So we're essentially setting the stage for investments as a concept. So you might often hear to make your money work for you, and that's essentially what an investment is. Your money becomes an employee. So bonds and stocks are the jobs options, lending versus ownership. So this is where we frame why companies care about investing, because obviously they want there to be returns, dividends, market value, and sometimes this also helps to build relationships with other firms. So as it relates to investments, we have equity securities and then we have what's called debt securities. So as it relates to equity securities, this is essentially where the owners, they are making an investment into the business. And this is in the form of common stock and then also in the form of preferred stock. And then debt securities, much like debt in our personal lives, where we have credit card debt, mortgage debt, things of that nature, organizations, companies, corporations, they also borrow money from individuals and other companies, and those are issued in the form of bonds and notes. So these can be purchased by individual investors, mutual funds, and other corporations. So these are the ways in which corporation raise funds to finance their operations. Again, selling equities, that represents ownership, and then debt, securities, and bonds, those represent a liability. So these securities, they're also called financial instruments. So just keep that in mind. And then later on in the chapter, we're going to discuss equity and debt securities from the perspective of the issuing company, the company that is given it. But as we are looking at this chapter, investments, we are essentially looking at it from the perspective of us essentially buying it. That's our focus in the chapter: investing in debt and investing in equity issued by another corporation. And sometimes it's not just corporations. Sometimes it might be governmental units, right? Governmental agencies. They have treasury bills, treasury bonds, and things of that nature. And the main objective is that they want to earn a return from the dividends or interest. So dividends are essentially paid to equity holders, and then interest is paid to debt holders, and they want to increase in the market price of the securities, and again to develop ongoing affiliations with the company whose securities are acquired. So as it relates to accounting for debt investments, so debt security, there's a specified date when it is going to mature, right? So let's say you buy a $5,000 3-year 5% certificate of deposit at a bank. What's going to happen is that you're lending the bank the $5,000 for 3 years, and the bank is promising to pay you a specified amount of interest, right? So that's ultimately a very clear example of your money making money for you, because you could just keep it in your bank account. But unfortunately, if you keep it in your checking account, that $5,000 today is still going to be worth $5,000 3 years from now, right? But if you have it in a savings account or some type of account where it's earning interest, that $5,000 can now maybe be, depending on the bank, obviously, because some banks they give you 0.000001, right? So you might have $5,005, right? But again, in this day and age, there are some high yield savings accounts. So maybe that $5,000 grows to 5,015 or 5,030 or even more, depending on the interest rate. But the key thing is that ultimately there's a maturity date, 3 years. There's a principal amount, which represents the initial amount that you invested, and then the annual rate. So companies, they invest in debt too. So like a CD or a bond, because again, the key thing is that the corporation or the governmental agency, they are borrowing the money. They take a principal amount from you, and they promise that they are going to pay you interest on top of paying you back the principal. So the principal and interest payments, they are a stream of cash flows that the investor receives in the future in exchange for purchasing the bond today. So here we have this quick example. It states on July 1st, 2027, Masterwear Industries issued $700,000 of 12% bonds dated July 1st. There's interest of $42,000 that's paid semi-annually. So anytime you see the word semi-annually, that means twice a year, semi, twice. And those dates are June 30th, and then we have December 31st. It states that the bonds mature in 3 years on June 30th, 2030. United Intergroup Incorporated purchased the entire bond issue on a date when the market interest rate for the bonds of similar risk and maturity was 14%. All right, so we see in this case some key things that we want to point out. Masterwear is the corporation that's issuing the bonds. United Intergroup Incorporated is the corporation that's buying the bonds. So that's something for us to keep in mind. We know that they issued the bonds for 700,000. The corporation Masterwear that issued the bonds, they're saying, "Hey, give us $700,000. We'll give you 12% interest on that amount." But United Intergroup Incorporated, they're saying, "If I invest in different types of bonds, I would get 14%, right?" So this just like think about it like this. You go to a grocery store, you are shopping for, let's say, milk, right? Store A has the milk for $5 and store B has the milk for $6. You'll say, "Why am I going to go pay $6 for this carton of milk when I can pay $5?" So we have what's called discounts, right? So because the individual, or in this case, the corporation, United Intergroup Inc., they can get 2% more, Masterwear is going to issue it at a discount. So that's essentially us tying into learning how to calculate the price that they are going to pay. So in such case, we see the interest, which is 42,000. That's the amount of payments that they're going to receive semi-annually every 6 months. And then we factor in the present value table and things of that nature, because again, whenever the amount, the stated rate, which is the interest that the corporation is going to pay, matches the market rate, the bond is issued at face amount. So you should remember this from accounting too. And then as it relates to the interest rate in the market being more than the stated rate, in such case is issued at a discount, as we see here. So in order to determine the price that United Intergroup is going to pay, we multiply those interest payments by the present value of an ordinary annuity, because remember, it's a set amount of money that they are receiving every 6 months, multiplied by the principal face amount, and we find the present value of a dollar factor. So based on that, we determine that United Intergroup Inc., they're going to say, "Hey, you know what? Yeah, we're missing out on the 2%, but we'll pay you $666,633. So therefore, that's ultimately making up for the loss of the 2%. So as it relates to bonds, as mentioned, whenever the market rate and the stated rate match, then ultimately everything, it's easy to account for, but that almost never happens, right? So we see that in that previous example, United, they paid $666,633 to purchase the bonds worth $700,000. The difference is that, again, Masterwear, they offered to pay 12%, but they could have received or obtained rather bonds from someone else and received 14% interest. So in order to attract those investors, that's why Masterwear had to sell its bond at a discount. So much like the example that I gave you with the milk carton, the company that is selling it for, $5, they might do something to essentially appease individuals, or the one that's selling it for $6. Hey, if you pay the $6, then you can also get a free carton of egg, or something of that nature. So same logic, ultimately they are attracting, they are appeasing the investor. So more generally, bonds generally, they're sold at a discount. And again, that's essentially where there's those difference. So fair value of a bond changes whenever the market interest rate changes. And the market value of a fixed rate investment, it moves in the opposite direction of the market rate of interest. So again, we see it being sold at a premium versus being sold at a discount. And this ultimately happens whenever there's a difference between the stated rate that was promised to be paid by the corporation in comparison to the market rate. And depending on the difference, it can either be sold at a premium or it'll be sold at a discount. So some key events in the life of a debt investment. So there's four key characteristics for all debt investments. The first is when the debt investment was purchased. The second is the receiving of periodic interest payments, because again, why am I going to lend you my money if you're not going to pay me anything? That's, kind of the logic behind it. Three, the holding of the bonds during the periods in which the fair value changes, because sometimes there's unrealized holdings, gains, and losses. A lot of things happen in the market, right? We see the political climate, sometimes that has an impact. War that takes place in other countries and things of that nature, they have an impact on the fair value, the market value of the debt investments. So you promise that you're going to have these bonds for 10 years. There's going to be a lot of fluctuations with as it relates to the value of that bond. Sometimes it increases, sometimes it decreases, and depending on the type of investment, it might be reflected on the financial statements. Maybe it's just a disclosure. It really all depends on the type of bond. And then lastly, selling the bonds before maturity or receiving the principal payment at their maturity date. So these are the key events in the life of a debt investment. Next, we have recording the purchase of a debt investment. So, whenever debt investments are purchased, they're recorded at cost. And that's the total amount that's paid for the investment, including any brokerage. So, based on the example that we saw previously, we know United, yes, the bonds are worth 700,000, but they paid $666,633. So, they're going to credit cash for the amount that was paid, and they're going to recognize the asset, the investment in a corporation for the 700,000, and the difference is going to be the discount on bond investment. So this is essentially what the journal entry would be. We debit the investment on bonds rather, which is the asset account. We credit cash, which is our asset, and we credit the discount on bond investment, which is essentially a contra asset account. So if you think about the accumulated depreciation account, which is a contra account to the equipment or whatever property, plant, and equipment that is being depreciated, it's essentially the same logic. So next we have recording the interest revenue, because again, that's one of the key things. As you are lending the money to the corporation, you also want to be able to get something back. So in this case, we know that every 6 months doesn't matter. They promise that they're going to pay us $42,000. So you might think, well, hey, how did they come up with that $42,000? It didn't generate out of thin air. So we know that the value of the bonds is 700,000. They promised to pay us 12%, but we're dividing it by 2. You might say, wait, what? Why are we dividing it by 2? Interest is always stated on an annual basis. And we know that, yes, we're paying them 12% interest for the full year, but we're making payments twice a year. So that is why we divide it by 2. We could have also done it the same way, 700,000 multiplied by 12% divided by 2. Since we're paying it in 2 installments, same thing ultimately. So the face amount multiplied by the stated rate divided by 2, that is how we come up with the $42,000 every 6 months. So at the end of the year, for the year in total, $84,000 was paid in interest. Next, we see for the interest revenue, the total amount that we are receiving. So the outstanding balance is going to be $666,633. And this amount is going to be multiplied by the market rate, which is 14% divided by 2. Again, the same logic because payments are made semi-annually. So the total interest revenue is $46,664. So as we look at the journal entry, we know the 42,000 represents the increase to cash. We credit the interest revenue for how much we've earned because again, listen, the market is paying me 14%. What about that extra 2%? So the difference is going to be a debit to discount on bond investment, which is ultimately going to decrease the balance in that contra asset account. So you might be thinking, hey, wait, what? I'm confused. Doesn't make sense. What's the logic? So United, they're recording the interest revenue using what's called the effective interest method. And it's the interest for the period that equals the market rate of interest, which we see is 14%. And then it's essentially multiplied by the outstanding balance of the debt at the beginning of the period, right? So with this effective interest rate method, at the end of every period, or every 6 months rather, we're going to need to figure out what is the outstanding balance. And that is ultimately going to help us to determine what the interest revenue is, and the difference between the interest revenue and the cash of 42,000. That is going to reflect the decrease to the discount on bond investment. So right now, this might still be like, I'm not understanding it. As we look at some more examples, it's going to start to make a bit more sense. And then here we have an amortization schedule, and this kind of helps to make it more understandable, more streamlined for the most part. So here we see that the date when they originally purchased it is January 1st, 2027. And then we also see that the maturity of the bond is June 30th, 2030. So in such case, we ultimately see that, hey, $42,000 is going to be paid every 6 months. We know that it's a 3-year bond. So in total, there's going to be interest of $252,000. And then we see that overall that there was interest revenue of $285,367. So ultimately, we know that there was a discount initially of $33,367. And at the end of the period, when the bond matures, the discounted balance in that contra asset account is going to be zero, and it is going to reflect the full value, the principal value of the asset. So that's why we set up the premiums and the discounts to ultimately account for that. So next, as it relates to classification of these debt investments. So as we mentioned earlier, the fair value of bonds, they'll change because sometimes there's things happening in the market. So they'll change as the market interest rates change, resulting in unrealized holding gains or losses. So unrealized holding losses, these happen when the market interest rates rise after the bond is purchased. And then unrealized holding gains, these happen when the market interest rate falls after a bond is purchased. So totally all depends. Maybe it's going to be an unrealized loss. Maybe it'll be an unrealized holding gain. So there's a continuation of the three classifications of debt. So as we have these unrealized holding losses, it really depends, right? We have to ask ourselves, well, are we going to account for it in our, financial statements? Do we need to? So it really all depends. So is it held to maturity? Are they considered trading securities? Are they considered available for sale? Depending on the answer to that question, that ultimately determines how they are going to be treated, right? So held to maturity, this is essentially where you're going to hold the debt until it matures, right? We don't plan to sell it at all. Doesn't matter what happens in the market, we are going to keep it, right? So in such case, with held to maturity, the unrealized gains and losses, they're not reported, right? And if we think logically, if I'm going to keep it until maturity, it doesn't really matter what happens in the market. I'm in it for the long haul. So when the debt investments are held to maturity, nothing is reported and it's carried in the balance sheet at the amortized cost. Next, we have what's called trading securities. So with our trading securities, this is used for debt that is held in an active trading account for immediate resale, right? So wait, we're going to resell it. That's the plan. It's a trading security. So in such case, it's going to be recognized in net income. Whenever there's unrealized holding gains and losses, we recognize it in net income and therefore retained earnings as a part of shareholders' equity. And trading securities, those are reported as of the fair value. So ultimately, we account for the increases and the decreases in the net income, and it's reflected in the balance sheet at fair value. Next, we have available for sale. They're used for debt. It does not qualify as held to maturity or trading. So we don't really know if we're going to hold it till maturity, and we don't know if we're going to resell it. So it's kind of just like in limbo, right? So with our available for sale, those are recognized in other comprehensive income. So with the other comprehensive income, This is essentially, it's reported in accumulated other comprehensive income in shareholders' equity, and it's also reported as of fair value. So again, that's the key thing. Held to maturity, we're in it for the long haul. Trading securities, yeah, we're gonna sell it. We have the intent to sell and available for sale. We're kind of in limbo. We don't know if we want to keep it to maturity, and we don't know if we want to sell it right now. We'll see what happens, pretty much. All right, so this is basically just an illustration rather, describing an annual report of UPS, United Parcel Service, where they're basically talking about how they account for unrealized gains and losses from their investments. They have trading securities, they have available for sale investments, and they ultimately, have a disclosure letting their investors know, their stockholders, right, bondholders, they're letting them know, hey, this is how we account for our unrealized gains and losses. All right, so this is just going into more detail about what we just mentioned. One of the classifications, held to maturity. So again, the investor, they have the positive intent and ability that they're going to hold it until maturity. So whether it increases, decreases, doesn't matter, right? Like when you think about in marriage, they say until death do us part. Think of it like that. Held to maturity, until maturity do we part. All right, pretty much. They're going to wait until it matures. So those increases and decreases, they have no impact. It's not going to be reported on the financial statements, and it's reported as of the amortized cost on the balance sheet. So here we have this example. We have the Wall Street Journal. They indicated that the fair value of the Masterwear bond as of December 31st, 2027 is $714,943. So again, the principal value is $700,000. How are they going to account for this increase in fair value? So because it's held to maturity, the investment is simply going to be recorded at the amortized cost. United, they might disclose the fair value of its held to maturity investments in a note to the financial statements. So it'll be shown maybe in a note, right? But they're not going to recognize any fair value changes in the income statement or on the balance sheet. So next we have a sale, right? What happens if we sell the investment? So here we see July 1st, 2027, Masterwear Industries issued $700,000 12% bonds dated July 1st, sorry. There's interest of $42,000 payable semi-annually on June 30th and December 31st. The bonds are going to mature in 3 years on June 30th, 2030. The market interest rate of bonds of similar risk is 14%. The entire issue was purchased by United Intergroup. So basically just restating the facts. But here it says, due to unforeseen circumstances, the company decided to sell its debt investment for $725,000. I mean, life happens, right? You get married, you don't intend to divorce, but it happens. So this was happening in this case, right? It was not until maturity do they part. So January 5th, 2028, they made the decision to essentially let go of the bond. So we know, again, just based off the logic, right, of accounting, we know that the cash is 725,000. So based on the bookkeeping principles, when there's an increase to our asset, we're going to debit it. So we debit cash, and then we know that we are going to credit the investment in bonds, which is based on the original entry that we set up. But we know debits and credits have to tie. So now we need to figure out, what was the original amount of discount on bond investment? So we know that we paid $660, $6,000, 663, right? So initially there was the discount of $33,367, and we received one interest payment thus far. And the difference between the interest revenue and the interest payment was this $4,664. So in our contra asset account, we have a balance of $28,703. And because we're selling the investment, we need to zero out this account. Got to get rid of it. So we debited for cash, for the amount of cash received. We debit the balance and discount on bond investment because we're totally getting rid of the bond. And now that leaves us with a gain on investment reported in net income of $53,703. So again, that's why it's very important as we begin to embark on the journey in this Intermediate Accounting 2 class. You need to solidify your understanding of the basics of accounting, because if not, you are going to struggle when it comes to recording the journal entries. But if you have a solidified understanding, then using logic, you can ultimately figure out what needs to be done with the journal entries. So next we move on to impairment of the held to maturity investment. So there's a very important rule, just like in taxation, in accounting, sometimes there's a caveat. There's something that you need to, an exception to the rule. So one important exception to the general rule that companies don't recognize unrealized gains and losses, and it's discussed in a previous chapter, right? But just like companies, they are required to account for, accounts receivable, bad debts, that are not going to be received, rather. In the same sense, companies, they also need to account for the impairment of held to maturities, right? So companies, they're required to use the current expected credit loss model to account for any credit losses on held to maturity investments. So this requires companies to make an estimate of the amount of interest and principal payments that they are not going to receive in the future. And companies account for that estimate by recognizing a credit loss in net income and reducing the carrying value of the held to maturity investment with an allowance for credit losses. So this is like, there's a corporation that started out, it looked good on paper, it seemed to be a very profitable venture, but unfortunately they went belly up, right? So we just lent this corporation $500,000, whatever the amount is. We're not going to get it back, right? And we're not going to get that interest. So in this case, there's an impairment of held to maturity investments. We anticipated to hold it until maturity, but because this company went bankrupt, we're not getting our money back and we're not getting the interest. So in a scenario like this is where you need to account for the impairment of the held to maturity investments. So the held to maturity securities, they do appear in the financial statements as follows. So we have our income statement, right? And in our income statement, they're going to be realized gains and losses. They're shown in net income in the period when the securities are sold. In the interim, when we are just holding them, nothing is reported. But when we sell them, that's where we report the realized gains and losses. Unrealized holding gains and losses, they are disclosed in the notes, but they do not affect other comprehensive income. As it relates to the balance sheet, the investments in the held to maturity securities, they're reported at the amortized cost less any allowance for credit losses, and the fair value of the investments, they're disclosed in the notes, right? So in the notes, that's where the investors, the creditors, they get information, but again, it does not directly impact the financial statements, but it is disclosed in the notes. And then lastly, cash flows from buying and selling held to maturities, they are typically classified as investing activities. So with the cash flow, we know that there's operating activities, which is within the normal course of operations of the business, investing activities, which ultimately are, when they are buying and selling property, plant, and equipment, and then financing, which ultimately ties into how the business finances its operations through equity and through debt. So this is just a quick example, a visualization of what it would look like for reporting held to maturity investments. So we see the statement of comprehensive income, and then we also see the balance sheet and how it would be reflected on the statement of cash flows. All right, so this is just, a depiction of the disclosure of the unrealized gains and losses on the held to maturity investment. So this would be reported in the notes to the financial statements, but not the financial statements themselves. So next we move on to trading securities. So as mentioned, these trading securities, they are investments in debt that's acquired for purposes of earning profits on a short term. sorry about that, on a short-term basis, right? This basically like, like a day trader, right? They purchase it and they have the intent, like, yeah, we're gonna flip this pretty much. So investments in debt or equity securities acquired principally for the purpose of selling them in the near term. So active buying and selling of securities. The holding period generally is measured in hours and days rather than months or years. It's typically reported among the investor's current assets because we know with current assets, those represent assets that are going to be used up within a year or less. And the fair value information in such case is more relevant, right? So they're carried at the fair value on the balance sheet, and unrealized holdings, gains, and losses, they're included in net income in the income statement. So here we have this example, and it states, assume masterwear bonds. They have a face value of $714,943 as of December 31st, 2027. So now we need to figure out what is the necessary adjustment that we need to make. So the fair value is $714,943. And the value, the amortized cost, is $671,297. So again, how do we get that amount? Keep in mind, we initially paid the $666,000, and we also need to account for the difference to the discount that was originally recorded. So because there's a difference between the amortized cost and the fair value, there needs to be an adjustment. So there's going to be a journal entry that is going to be recorded at the end of the year to ensure that in the financial statements, the bonds are reported at the fair value. So it will be reflected as follows. We would debit this account, the fair value adjustment account, for $43,646, and we would credit the gain on investments unrealized net income for $43,646. So increases in the fair value adjustment is going to produce gains on the trading securities that increase the net income, and decreases produce losses that decrease the net income. So because there's a gain, there's a difference, the fair value is more than the amortized cost. That's why we credit our gain on investments for unrealized net income. So now let's say we decide to sell it, right? We're selling a trading security in this case. So it states, assume United sells the bond for 725,000 January 5th, 2028. So in such case, we know that the fair value is 725,000, and or how much we're selling it for is 725,000, and the amortized cost is 671,297. So if we remember, there was an adjustment when it was 714,000. We increased it by 43,646,000, and we see now that it's being sold for 725. We compare it to the amortized cost. We needed to reflect the fair value. So that difference is 53,703. So think of it like a bank account, right? You need $53,703 to put down for a deposit, for a down payment for a home, car, whatever it is. You need $53,703. So how much money you need ultimately depends on how much you have saved, right? That's how I think of it when we're looking at the T accounts. So if I have $0 saved, I need $53,703 to meet my goal. But in this case, I already have $43,646 saved. So therefore, I ultimately only need $10,057. How do we get the difference? 53,703 minus the amount that's already in my bank account balance, 43,646. The difference is $10,057. So therefore, the journal entry is a debit to the fair value adjustment account and a credit to gain on investments, unrealized net income. So this is just a continuation. We record the sales transaction. So we know we're getting 725,000 in cash, so we debit cash. We credit the investment in bonds because we know that ultimately, hey, we are getting rid of this bond, and it was originally reported on the books as 700,000. We debit the discount on bond investment. That amortized amount, we want to get rid of that as well. So we zero it out and debit it for 28,703. And the difference represents our fair value adjustment. So here it asks, well, what happens if the company doesn't update the fair value as of January 5th, 2028? So as noted in the FASB, the Financial Accounting Standards Board 3201040, ultimately they expect companies to do its best, right? So here it says, as noted, for expediency, companies may not update the fair value adjustment to the fair value as of the date of sale before recording the sale, and in such case the investment is carried at fair value as of the last balance sheet date. And the second entry is going to include a gain or loss based on the difference. So this is essentially if the company didn't make that adjustment. We saw in the previous journal entry, it was just fair value on adjustment for the full amount. But we ultimately see, hey, they did not do it. So therefore, the journal entry would be as follows. It would be broken out. That 53,700 amount would be broken out for fair value adjustment and then broken out for gain on investment, right? We're basically zeroing out what we reported before with the previous entry and then now accounting for the gain on investment. Same logic, just a different account, right? Assuming that they did not update the fair value adjustment. All right, so as you can see, there's a lot of nuance, all right, in this area, but it's important to know. And again, I will continue to stress the fact that understanding the basics of accounting and, why do I debit this account or why do I credit this account helps to understand. So as it relates to the financial statement presentation for trading securities, income statement and the statement of comprehensive income, gains and losses, they are included. They account for the fair value changes regardless of whether they are realized or unrealized, right? It's reported in the net income. It does not affect other comprehensive income. Balance sheet, they are reported at fair value, typically as current assets, because again, we have the intent to sell them. And then the cash flow statements from buying and selling trading securities. So this is a part of the normal course of operations. This corporation normally buys and sells securities. So therefore, it is a part of their operating activities, not a part of investing. All right, and this is just kind of a visualization of what it would look like. So you can feel free to spend some time to go through that in more detail. And then now we are looking at the last classification, are available for sale. So we know that our held to maturity, that assumes that we're holding them for your entire life. Trading securities, we're planning to sell them in the near future. But this third treatment, available for sale, kind of falls in the middle. Again, it's kind of like they're in limbo. We don't know if we want to keep it. We don't know if we want to sell it, pretty much. So our available for sale securities, they aren't either of the two. The investment is available for sale, but we might keep it. We don't know. It's reported in the balance sheet at fair value. Unrealized holdings, gains, and losses, they're not included in net income, but they're reported in statement of comprehensive income as other comprehensive income, right? So they aren't planning to trade the debt investment actively, but again, if they need to sell it, maybe they need money, right? Or the market is favorable, they might sell it. So in such case, that is ultimately why they report it in the statement of comprehensive income as other comprehensive income, OCI. So why do they use this approach? Ultimately, because again, the key thing is that with this approach, we ultimately are accounting for the fact that, hey, might sell it, might not, and there might be some unrealized gains or losses. And with these securities, they're likely to be held for multiple reporting periods. So we want to account, for the increases and decreases, because sometimes it can confuse the investors. It might seem more volatile, but that's why they ultimately reported at fair value. Again, not impacting the net income, but the other comprehensive income. So that's the solution, to basically show these unrealized gains and losses in OCI as they occur, and then only include them in net income when they actually sell it. But with the available for sale, kind of just helps the investors to get a better picture of what's really going on. That's why it's reported at fair value. So here it's saying let's assume master water bond investments classified as AFS, right? Same information. There's an amortized cost of 671,297. The fair value is 714,943. So the journal entry is ultimately the same, but instead of it being unrealized NI, net income, it's unrealized other comprehensive income. And then it's asking, in the event that they sell. So the journal entry is ultimately the same. So much like with trading securities, we first updated the fair value adjustment to recognize the unrealized holding gain. And then now when they sell it, we are accounting for the amount that's already in the balance, the account, which is $43,646 versus what it needs to be. And that is why we debit the account, debit fair value adjustment rather, for the 10,057, and we credit gain on investment for the 10,057. And this is just, assuming they sell it. So in such case, to reverse the previous fair value adjustment, what they would do is to debit the reclassification adjustment for other comprehensive income, right? Because remember, it was in other comprehensive income, didn't impact the net income. And then now they're accounting for the amount based on the sale. All right, and this is just us ultimately concluding. So here we have the journal entry. Again, it looks a bit similar to the trading securities. We debit cash for the discount on bond investment. We credit investment on bonds for the 700,000, and then we credit the gain on investment for the difference. So let's say that there's an impairment of available for sale investment. So companies, they're required to account for impairment of available for sale securities, but the accounting depends on management. So if the fair value is less than the amortized cost, then impairment is going to exist. Accounting for the impairment, it ultimately depends on management's belief about whether or not they're going to sell the investment. So if management, they intend, hey, it's more likely than not that we're going to sell it before the fair value recovers, then the available for sale investment is going to be written down to fair value, and the impairment loss is going to be recognized in net income. But if management does not intend to sell the investment, and they don't believe that it's more than likely that they're going to have to sell the investment before, that management, they're required still to make an estimate and recognize the credit losses, and then ultimately reduce the carrying value of the available for sale investment by using the allowance for credit loss. So again, there's a lot going on with these debt investments that needs to be accounted for. So as it relates to the financial statement presentation of available for sale, as it relates to the income statement, unrealized holding gains and losses, as we mentioned, they're reported in the other comprehensive income in which the changes in fair value occur. And those amounts, they're reclassified out of other comprehensive income, and they're recognized in net income in those periods in which the securities are going to be sold. Next, we have balance sheet. So the investments in available for sale securities, they're reported at fair value. And the unrealized holding gains and losses, they become a part of accumulated other comprehensive income, part of the shareholders' equity, and then they're going to be reclassified out of it when they actually sell it, as we saw in the previous journal entry. And we have cash flow. So the cash flow, buying and selling available for sale securities, they are classified as investing activities because, again, they don't plan to hold it to maturity and they're not actively trading. So it more so falls in line with investing activities in comparison to trading securities, where they're actively selling, buying, and selling. Therefore, it's a part of their operating activity. So very important to differentiate between the two. So as it relates to reporting for the available for sale securities, this is a visualization of what it ultimately looks like in the different financial statements. So you can feel free to spend more time looking into that. And then here we just see ultimately a note. So individual securities available for sale, they're classified as either current. We know current assets within the 12-month period, non-current more than 12 months, depending on how long they are likely to be held. And this is just an example of Cisco systems and how they accounted for their available for sale. So here we have a note. Summary of available for sale debt investments. In part, they have some government securities, government agency securities, some non-government corporate debt, commercial papers, CDs. So they basically break all of them out. So this chart here is essentially just a depiction of the different types of debt investments. We have the held to maturity, we have the trading securities, and then we have the available for sale. So now you essentially get a better understanding of the approaches and how they are accounted for. So when we purchase the bond, it's going to be reported the same way. Doesn't matter if it's held to maturity, trading, or available for sale. Still going to be recorded the same way. Interest revenue still going to be reported the same way. But the key difference is ultimately if we account for the adjustments to the fair value. For held to maturity, we do not account for it. For trading securities, we account for the adjustments in unrealized net income. And for available for sale, we account for it in unrealized other comprehensive income. All right. And then when we sell the bond, there's also a bit of nuance there. But the key thing is just remembering the different types of approaches and then ultimately how they account for the adjustments to the fair value based on the classification. And as we know, sometimes there are some differences between GAAP, generally accepted accounting principles, in IFRS, International Financial Reporting Standards. So IFRS number 9 governs the treatment of debt and equity securities. So under US GAAP, they allow held to maturity and available for sale classifications, and it allows specialized accounting for particular industries like securities, brokers, dealers, investment companies, and insurance companies. So let's say as you are going through this chapter, you are very intrigued. You might just specialize in working with corporations and accounting for their debt investments, right? Under IFRS, more restrictive classifications including amortized cost, fair value through other comprehensive income, or fair value through profit and loss, and it does not allow specialized accounting based on the industry. So as we can see, there are some differences for US GAAP and IFRS. All right, and this should basically just cover some transfers between the investment categories. So at each reporting date, the appropriateness of the classification is reassessed, right? So in one period, maybe it was treated as held to maturity, but you know what? Maybe now it needs to be available for sale, or maybe it now needs to be trading. So whenever there's transfers in such case, then it needs to ultimately be reclassified. So when a security is reclassified between the two reporting categories, then the security is going to be transferred at its fair value as of the date of transfer. And then obviously any unrealized holding gain or loss is going to be reclassified, and it needs to be reclassified in a manner consistent with the classification which was being transferred to. So in such case, let's say it starts off at held to maturity. Well, look at the first one. It's starting off at held to maturity. Now it's going to be traded, right? In such case, because it's no longer going to be held to maturity, it's trading, we know that the unrealized gains and losses, they're going to be accounted for in net income. So very, very important. Again, at the end of each reporting period, they do assess it because things happen, right? Just like in a marriage, till death do us part, some things happen and some changes are going to be made. Same thing. You reassess at the end of each period. And this is basically just, looking at the differences between IFRS. So under GAAP, they allow transfers out of the traded security, but reclassifications under this continue to be rarer events than what occurred under IFRS with this change. So GAAP, they do allow transfers out of the trading security. So maybe they're like, hey, you know what? I think we're actually going to hold this to maturity, right? Or maybe they come on the fence and it becomes available for sale. Under IFRS, transfers of debt investments between the amortized cost, fair value of other comprehensive income, and FVPL categories, those occur only if the company changes its business model with respect to the debt investment. So IFRS, International Financial Reporting Standards, they're a little bit more stringent with there being a transfer. So as it relates to the fair value option, The election is optional, but it's irrevocable. So once the change is made, it cannot be changed. That's what irrevocable means. So the election is optional but irrevocable on the date of investment purchase. So under the fair value option, held to maturity and available for sale investments, they're shown in the balance sheet at the fair market value. Unrealized gains and losses, they're recognized in net income in the period in which they occur. And any purchases and sales of investments, they're likely to be classified as investing activities. And again, this is just looking at the difference between GAAP and IFRS. Under US GAAP, it's less restrictive. There's more, leniency. It indicates that the intent of the fair value option is to address specific circumstances, but it doesn't require that those circumstances need to actually exist. IFRS, on the other hand, more restrictive than US standards for determining when firms are allowed to elect the fair value option. And under IFRS number 9, companies, they can elect the fair value option, but it has to meet a specific scenario. So it has to, the scenario needs to have been met. So this is just covering the financial statement presentation and disclosure. So trading securities held to maturity, available for sale. Again, they are either current or they're non-current, and that's depending on when they're expected to mature or to be sold. So it's not necessary, that the company reports the individual amounts for these categories. However, on the balance sheet, there is a requirement for disclosure notes. So investors, they should disclose the following in the disclosure notes for each year presented. So the aggregate fair value of these debt investments, the gross realized and unrealized holding gains, the gross realized and unrealized holding losses, change in net unrealized holding gains and losses, and their amortized cost basis by major security type. So they are required. These notes, they basically include these disclosures, and it helps financial statements users because, again, with financial accounting, these statements are being used by outsiders in order to make investment decisions. Hey, should we lend this corporation money, right? Should we invest in this corporation, right? So decisions are ultimately being made by these financial statements, and the disclosures help the investors to get a better picture, a more holistic view of the company and how it is doing. And here we just have this illustration of HP Incorporated, right? So they're basically showing us the different, assets. And then we see corporate debt, government debt are available for sale, financial institution instruments, and things of that nature. So here we see from these disclosures that HP, they have level 1, then they have level 2, and they have level 3 types of investments. So this ultimately just gives financial statement users a better understanding of ultimately, what's going on, what's the big picture with this corporation as it relates to their debt investments. All right. So this brings us to the end of Chapter 12, investments, where we just covered debt investments and how those are handled. So the key things for us to keep in mind is that ultimately, as it relates to debt investments, we have three classifications. We have held to maturity. That is ultimately where they are deciding we're gonna, hold on to it for better or for worse. There might be a scenario where they sell it, but for the most part, the intent is for the long haul. Trading securities are those that they are actively buying and selling. It's a part of their normal course of operations. And then we have the available for sale where we don't know if we want to hold it to maturity. We don't know if we want to sell it. They're kind of in limbo pretty much. So in such case, based on the classification, that ultimately determines if they are going to make adjustments for the increases or decreases in value. Held to maturity, there's no adjustments for the changes in fair value. Trading securities, we recognize the unrealized gains and losses in net income. For available for sale, we recognize the unrealized gains and losses in other comprehensive income. And we also learn that there are some nuances between how these debt investments are treated for GAAP, generally accepted accounting principles, versus IFRS, International Financial Reporting Standards. All right, so that brings us to the end of investments, accounting for debt investments. In the next video, we'll learn about accounting for equity investments.